Hello everyone, welcome to EduTap and welcome to today's very important session where we are going to revise the RBI notifications, the RBI press releases and the finance current affairs from your April 2026, which is a very important month from the RBI Grade B examination point of view. Okay, so this session is going to be very important for all of you. Here we are going to discuss and we are going to revise the most important RBI notifications, RBI press releases and the finance current affairs in the MCQ format. So first I will provide you the MCQ and then we will discuss the idea behind the notification or the press release or the finance current affairs. Okay, so in total there are more than 50 questions that we are going to discuss so that you have the comprehensive coverage of the important notifications, press releases, finance current affairs. Give me a thumbs up if I am clearly audible and the screen is clearly visible. As you know that you should be attempting a lot of new MCQs, so for that this session is very helpful. Okay, because we are going to see more than 50 MCQs in this one session. So give me a thumbs up if I am clearly audible and the screen is visible. I hope everything is fine. Okay, so let's get started. And first we are going to discuss the RBI notifications and the press releases, and we are going to see the questions, the MCQs from the most important RBI notifications and the press releases of April 2026. So the first question is in front of you, and do not worry about the PDF. You will get the PDF of the session and the PDF will be provided to you in the Telegram channel of EduTap. Okay, so in the Telegram channel of EduTap, you will be getting the PDF of this session. So now the first question is in front of you. Now try to answer this first question. As per the RBI's updated operational guidelines on the floating rate savings bond 2020, which of the following statements is correct? So as per the updated guidelines, which of the following statement is correct? And this is very important from the examination point of view. It was released in April. Okay. Now, the minimum investment in the bonds is the minimum investment in the floating rate saving bond should be how much? 1000. Okay. Payment for subscription can be made in cash up to how much only? Up to 20,000 only. The bond shall be repayable on expiry of 7 years. So this is correct. The coupon is linked. The interest in the floating rate saving bond is linked to the national saving certificate with an added spread of 35 basis point, not 25. So lock-in period for investors in the age bracket of 60 to 70 shall be how many years from the date of issue? 6 years. So the right answer here is C, that only the C statement was correct and that's why that is the right answer. So the floating rate saving bond, the minimum investment is 1000 and only the resident individual and the Hindu undivided family, only these can be the eligible investors in the floating rate saving bond. We have discussed this in the Finance 360-degree session also, that the bond shall be repayable on the expiry of 7 years. The payment in cash can be only up to 20,000 and the interest on the floating rate saving bond depend upon the national saving certificate with a positive spread of 35 basis point, that is 0.35%. Okay. Now we have also discussed about the premature encashment. Lock-in for the age of 60 to 70 is 6 years. That means after 6 years they can sell their floating rate saving bond. 70 to 80 5 years and 80 and above 4 years. Okay. Now coming to the next question, try to answer this question, that with reference to the operational guidelines of floating rate saving bond, which of the following are eligible to be nominated on behalf of an investor? So who can invest? Only the resident individual can invest, or the Hindu undivided family. Only these can be the investors in the floating rate saving bond. But who can be nominated on behalf of the investor? That if in case the investor dies, then this person will get the money. So the resident Indian, the non-resident Indian, they both can be nominated on behalf of the investor. The overseas citizen of India cannot be nominated. So here the right answer is 1. That is A. So remember this, that only a resident or non-resident Indian, they can be nominated by the applicant or the investor. Overseas citizen of India is not permitted to be nominated for the bond. There are also the fees, like the bank or the receiving offices. Basically they provide the receiving offices, that can be a bank or the non-bank. They provide the access to the floating rate saving bond, and for providing the access to the floating rate saving bond, they also get some service charge from the Reserve Bank of India, from the Government of India. Okay, so this is the idea. The service charge the receiving officers are paid 25 rupees for opening the new bond ledger account for the new investor in the floating rate saving bond. The 20 rupees is paid for servicing the existing bond ledger accounts, and the brokerage fees is also there. So we have discussed this all in the detailed session. So this is provided to you for revision so that you can revise the important points. Okay, so focus on the important points and do revise it, that the brokerage of 50 paise per 100 rupee of the subscription amount that is mobilized by the receiving offices for the floating rate saving bond. So this is the brokerage fee. There is also the handling fee, that is 1/16 of the 1% of the subscription amount mobilized. Now, next question is regarding the master direction that has been released by the Reserve Bank of India. So RBI has issued the master direction on the incentives for currency distribution and exchange. Now, which of the following statements is or are incorrect in regard to the master direction? Try to answer this question. Banks are eligible for reimbursement. So simply the master direction has been released by the RBI regarding the scheme of incentives for the currency distribution and exchange for the banks for the currency chest. Okay, now the banks are eligible for reimbursement of up to 100% of the capital cost for opening the currency chest in the northeastern region and at inaccessible or hilly places of Jammu and Kashmir and Ladakh Union Territories, subject to the ceiling of 50 lakh. This is correct. 50% of revenue expenditure is eligible for reimbursement for the first 3 years of the currency chest operations. So this is incorrect, because is it for first 3 years? Is it for first 3 years? No, it is for first 5 years. Very good. It is for first 5 years. So this is incorrect. Distribution of coins has the incentive of 65 rupees per bag for the distribution of coins, and the additional incentive of how much per bag for the coin distribution in the rural and the semi-urban areas. So 10 is the rupee 10 is the additional incentive for the coin distribution in rural and semi-urban areas. So the third statement is also wrong. So only the first statement is correct, and that's why the right answer here is D. That is, second and third were wrong, only first is correct, and that's why D is the right answer here. Very good everyone. Chalo. Yes, absolutely correct, Abhi and Kashish. Now, scheme of incentives. So basically, incentive is provided for opening and maintaining of the currency chest in the far off areas. The capital cost is covered of 100%, but there is a ceiling of 50 lakh. Revenue cost is covered 50% for the first 5 years. And for the exchange of soiled notes, there is 2 rupee per packet of 100 notes. And for the mutilated notes, 2 rupee per piece. For the coins, for the distribution of coins, 65 rupees per bag for the distribution of coins, and the additional 10 rupees incentive for the distribution of coins in the rural semi-urban areas. Okay? Now the service charge is also taken by the currency chest for providing the services of the large modern currency chest, 11 rupee per 100 pieces of the deposit in the currency chest. For the other currency chest, there is the 8 rupee per 100 piece of the deposit in the currency chest. Now, coming to the next question, try to answer this question. What is the penalty that is imposed on a bank? So there is also the scheme of penalty that is released for the bank branches and for the currency chest for the deficiency of services by the bank branches or for the deficiency of the services by the currency chest. So what is the penalty that is imposed on a bank branch in case there are more than 5 instances of deficiency in service by the branch in a calendar year or earlier, as directed by RBI officials in regards to the master action that the RBI has released? So yes, for one case, for one instance, what is the penalty? Can anyone tell me that for one instance, what is the penalty? For one instance of the deficiency in service, the penalty is 10,000, and for more than 5 instances, the penalty is 5 lakh rupees. Okay. So here the C is the right answer. So deficiency in service in providing the exchange facilities as directed by the RBI officials. So 10,000 for any deficiency of service, and for more than 5 instances, 5 lakh rupees is the penalty. Okay. Now, the small finance bank, up to 2 years from the commencement of their banking business, and payment banks, they may exchange the mutilated and the imperfect notes at their option. But for the other banks, it is compulsory to exchange the soiled notes, mutilated notes, and the imperfect notes. The small finance banks and the payment banks, it is compulsory for them to exchange the soiled notes. But for the mutilated notes and for the imperfect notes, there is no compulsion for the small finance bank and the payment bank. Okay. Next, as per the master action on incentives and penal provision for bank branches and currency chest in respect of currency operations, counterfeit notes of denomination 100 and above. So if there are counterfeit notes, that have been detected in the currency chest balance during inspection or audit by RBI, there is the penalty of what percentage of the notional value of the counterfeit notes that will be taken in addition to the recovery of the counterfeit notes, in addition to the recovery of the value of the counterfeit notes. Yes, very good. 200%. 200%. And if, see, basically, if in the currency chest balance, there are counterfeit notes that have been identified for 100 rupee and above, then the penalty that RBI will be charging will be 200% of the notional value of the counterfeit note. In case of the counterfeit notes, that have been found in the soil note remittances by the currency chest. In this case, if 100 rupee and above notes have been found, counterfeit notes have been found in the soil note remittances that have been sent to the RBI by currency chest, there will be a phased penalty that will be applied. If the counterfeit notes per million notes is less than 5, then the penalty will be 100%. If it is equal to or more than 5 but less than 20, so the penalty will be 150%. If the counterfeit notes are equal to or more than 20 but then the penalty will be 200%. So this is the idea. Okay. So under the master action, the penalty for counterfeit notes detected in remittances, if the counterfeit notes are detected in the soil note remittances sent by the banks or currency chest to the RBI, in the case of the small notes, only the national value will be recovered. For 50 rupee note, the notional value will be recovered and the penalty of 50%. For 100 rupee and above, if the counterfeit notes they have been found in the soil note remittances by the RBI from the currency chest, so the penalty will be imposed if there is the 100 rupee and above counterfeit notes that were found. Okay, penalty will be 100% if the counterfeit notes per million is less than 5. If the counterfeit note per million is more than or equal to 5, less than 20, 150% penalty. If the counterfeit note per million is more than or equal to 20, then 200% penalty. In case counterfeit notes are detected in the currency chest balance, in the currency chest main account or main balance, so in this case, for denomination of 100 rupee and above counterfeit notes, the penalty of 200% will be the direct penalty. That is the idea. Now coming to the next question. Try to answer this question. As per the RBI master action on incentives for currency distribution and exchange and penalties, what is the minimum amount prescribed for depositing into or withdrawing from a currency chest? So I have taken a detailed session on the master action for the scheme of incentives and the scheme of penalties, and there we discussed that what is the minimum amount prescribed for depositing into the currency chest, or if you are withdrawing the money from the currency chest, so what is the minimum amount that is prescribed? 50,000. Very good, everyone. 50,000 is the answer here, and in multiples of 50,000 is the minimum amount, and after that in the multiples of how much? In the multiples of how much? In the multiples of 10,000. Okay. So minimum 50,000 can be deposited or withdrawn from the currency chest in the multiples of 10,000. Now coming to the next question. As per the master action on counterfeit notes detection, reporting and monitoring, if up to dash counterfeit notes are found in a single transaction, they are reported to local police authorities at the end of the month. So this is a separate master action that is released. In this particular master action, only 2-3 important points are there, so that we will discuss in the revision session itself. Okay, so in the master action on the counterfeit notes, so this master action is released for the counterfeit notes specifically. If up to how many notes are found in a single transaction, they will be reported to the local police authorities at the end of the month. So if up to 4 counterfeit notes are found in a single transaction, so this is the answer. Okay, B is the answer. Yes. So basically, fake notes must not be returned to the customer or destroyed by the bank branch. If up to 4 counterfeit notes are found in a single transaction, the nodal bank office shall report it to the local police authorities at the end of the month. However, if 5 or more counterfeit notes are detected, they have to be immediately reported to the local authorities, to the police. Counterfeiting, as defined under the Bharatiya Nyaya Sanhita 2023, also includes foreign currency notes. Any suspected counterfeit foreign currency note shall be referred to the Interpol wing of the CBI, New Delhi. Establishment of the forged note vigilance cell at the head office of bank. So every bank head office should have a forged note vigilance cell which will collect and compile the data on the detection of the counterfeit notes and report the same to the Reserve Bank of India by the 7th of the succeeding month, to the Financial Intelligence Unit India by the 15th of the succeeding month. Data on counterfeit notes detection shall be uploaded on the web enabled software of the National Crime Records Bureau, New Delhi website also. Okay, so this is the idea. As well as the FNV cell also has to submit a half-yearly status report to the concerned RBI issue office within 15 days from the end of each half year. This is it. Now, coming to the next question, as per the RBI, see, RBI has provided trade relief measures because of the West Asia crisis. So, trade relief measures directions 2026 have been released, and basically the trade relief was provided in 2025. That trade relief has been extended further. Okay, within what maximum period can an exporter repay the export credit? So normally the export credit has to be returned. The pre-shipment or post-shipment export credit has to be returned within 270 days. But under the trade relief measures, there is the extension of timeline that is provided for the repayment of export credit, that is 250 days. Okay, so within 450 days, sorry. So within 450 days, export credit has to be repaid. Normally, the time period is 270 days. Within 270 days, export credit has to be returned, but the extension of time has been provided, and now within 450 days, the repayment of export credit should happen. So here the answer is D. Yes. Now, under the Reserve Bank of India Trade Relief Measures Directions 2025, exporters, they are permitted to avail trade relief benefits in respect of credit facilities. So basically, if a exporter has taken the export credit pre-shipment or post-shipment, export credit has been taken. This export credit normally would have to be repaid within 270 days, but now the extension of time says that the export credit can be repaid within 450 days. Now the export credit can be taken through which institutions? That can be repaid within 450 days now. So commercial banks can provide the export credit, or such trade relief measure is providing the relief if the loan has been taken from the commercial banks, NBFC factors, not account aggregators, urban cooperative banks, state cooperative banks, all India financial institutions. So 1, 3, 4 and 6 is correct. 2 and 5 is incorrect. So 1, 3, 4 and 6 is the 1, 3, 4 and 6. C is the answer here. Okay. Yes, 1, 3, 4 and C. So C is the answer. So basically, in response to the geopolitical uncertainties and the logistical disruptions, the supply chain disruptions arising from the West Asia crisis, the RBI had earlier introduced the trade relief measures for the exporters. Now the time allowed to repay the export loans, that is the pre-shipment or post-shipment export loans, was increased from 270 days to 450 days, as well as the export earnings have to be brought in India within 9 months. This time period has also been extended to 15 months. Now it has been said that previously the export credit repayment benefit of 450 day, like within 450 days you can repay the export credit. This was only up till March 31st 2026. Now the timeline has been increased till June 30 2026. So if you are taking loan, if you are taking the export credit up till June 30th 2026, you will get the extended timeline of 450 days for the repayment. Okay, as well as the 9 month to 15 month, you had to bring back the export earnings within 9 months, but now you can bring back the export earnings within 15 months. This window to bring back the export earnings is provided until further notice of the RBI. Okay. Who can provide the trade relief measures? So commercial banks, primary urban cooperative banks, state cooperative banks, central cooperative bank, NBFC factors, and all India financial institutions, they can provide the trade relief. Now, under the Reserve Bank of India Trade Relief Measures Directions 2025, an exporter can realize export proceeds or take the export proceeds within a maximum period of how many months? So the timeline was increased from 9 months to what? 15 months. Very good, Abhi. Very good, Kashish. Correct. 15 months. So this is the idea that normally the export proceeds or the export earnings have to be brought back to India within 9 months, but now the timeline has been extended under the trade relief measures to 15 months. This is the idea. Now coming to the next question, that with reference to RBI's directions on overseas investment. See, if the overseas investment is happening and it comes under the approval route. Approval route means that the investment is more than the limit under the automatic route. If you want to do the investment more than, if you want to do the investment, or if you want to do the investment in the other country more than the limit under the automatic route, so you will have to take the approval of the RBI. So RBI has now shifted to a decentralized system wherein overseas investment references or overseas investment application request shall be processed at how many regional offices of the RBI. So before, such kind of applications were being such kind of applications were only processed by the RBI central office. Now they can be processed at the regional office. How many regional office? 7 regional office. Very good, very good. What about the others? Why only 2 students or 3 students are able to answer? Try to answer, everyone. Okay. Try to see that how many of the guesswork or logical logical input you are able to add. Even in examination, maybe you will not be able to recall immediately, but in the back of the mind, you will understand this, that you have studied it somewhere. So you will have to have the recall. And even if your gut is saying that, okay, this can be the answer, that is basically you have studied it and your subconscious mind is able to remember it. Okay, so try to believe in your gut, try to believe in that feeling, and try to answer the questions. Now 50 plus questions are there, so if you can see that your gut, your subconscious mind is able to take you to the right direction or not. So try to answer the questions. Okay, so now earlier, if any Indian person or company, they wanted to invest money abroad under the approval route, that means under the automatic route, let's say under the liberalized remittance scheme. Under the liberalized remittance scheme, what is the limit of the investment that you can do? So the current account, the capital account transactions that are allowed for the resident individuals, there is a limit for that. In a financial year, you can only do the investment of up to $250,000. So this is automatic. Here you do not have to take the permissions. But let's say you want to invest more, or if you want to invest more, or if you want to have more money than that, so then you need to take the approval. So if the Indian resident or the Indian resident company want to invest more abroad under the approval route, where the approval has to be taken from the Reserve Bank of India, the investor or the resident person or the company can request the overseas investment through the authorized dealer banks, and the authorized dealer banks will further or will send this request to the RBI, where the processing of the request will happen centrally at the Foreign Exchange Department, Central Office of the Reserve Bank of India. So basically, if you want to take the approval for higher investment, then what the limits are under the automatic route, so you have to take the approval. The investor that wants to invest more can send the application or the request through the authorized dealer bank, that will further this request to the RBI, to the Foreign Exchange Department, Central Office of the RBI. But there was only the centralized processing of the request that was happening, and at one place there was too much pressure that was going. So now RBI has shifted to this decentralized system, wherein overseas investment request or the application shall be processed at 7 regional offices with effect from April 1, 2026. Now, the foreign entity that is getting the investment from the Indian residents or Indian company that has a unique identification number. Now the prefix will be added to show that this particular request or this particular application for the investment in this company is being catered to in which regional office. So there are 7 regional offices that will cater to the applications or the request for the higher overseas investment. That is the basic idea. Now, if the authorized dealers banks which were forwarding such applications or requests to the central office, now they have to forward it to the regional office through the Prava portal. Now, coming to the next question, with reference to RBI's directions on overseas investment, who is responsible for submitting overseas investment references to the regional offices of the RBI? So the investors, they can invest through the authorized dealer banks, and the authorized dealer banks are the one that will proceed, that will further this request to the RBI regional offices. So it is authorized dealer banks. Okay. Now coming to the next question, that as per RBI's overseas investment direction, how much minimum equity stake is required for an investment in a listed foreign equity to be classified as overseas direct investment? So in the direct investment, or the foreign investment will be considered the foreign direct investment if in the shares, if in the equity, there is the investment of at least 10% of paid up equity capital. Okay. So the investment will be considered overseas direct investment if there is 10% or more than 10% of the investment in the paid up equity capital in the equity. Yes, 10% or more than that. Now, see, in the liberalized remittance scheme, there is the limit that how much the individuals can invest or how much individuals can use the foreign currency. So the limit is 2,50,000 in a financial year. Now, for the Indian entity, this limit under the liberalized remittance scheme, it is for the resident individuals. But what about the entities? What about the resident entities? So resident entities, they must take prior approval when its overseas financial commitment in a financial year exceeds what limit? So what is the limit for the Indian entities beyond which they have to take the RBI approval? So the limit is $1 billion. Okay? The limit is under the RBI's overseas investment direction, financial commitment by an Indian entity exceeding $1 billion in a financial year shall require prior approval of the Reserve Bank of India. Now, coming to the next question, that with reference to FPI investment limits for financial year 2026-27, what match the list 1 and list 2? So this we have discussed in the Finance 360-degree session also, where the limits were discussed, that the foreign portfolio investment limit is there. For the government securities, the limit is 6%. State government securities, the limit is 2%. For the corporate bonds, the limit is 15%. So here the answer is first ka C, and through this, okay, C is the answer basically. So these are the limits. These are the limits of the investment by the foreign portfolio investors under the general route. So this is the investment limit in the different securities that can be invested by the foreign portfolio investors. Now for the credit default swap, RBI has prescribed the limit on the credit default swap that can be provided by the foreign portfolio investors. So credit default swap, that means there can be the banks that are providing the loan. Now the banks are afraid that what if this loan is defaulted, the borrower defaults, so the banks can take, or the lenders in the country, they can take the credit default swap. That means it is a kind of insurance that the banks are filling the insurance premiums, the banks are providing the premiums, and if the loan defaults, then the credit default swap, the default will be handled through this other company. Okay, so what is the limit of credit default swap that can be provided by the foreign portfolio investors? So the aggregate notional amount of credit default swap shall not exceed what percentage of the corporate bonds, stock of corporate bonds. So in case the bank has lent the money through the debt instrument, that is the corporate bond. So this is the XYZ corporate entity, and the bank is providing the loan to this corporate entity through this debt instrument, that is a corporate bond. So the XYZ entity has taken this debt through this debt instrument. What if the XYZ entity defaults? So the bank is taking the credit default swap to protect itself. Okay? So here 5% is the limit that the credit default swap can be taken from the foreign portfolio investors up to the limit of 5%. Yes, very good everyone. Now coming to the next question, that is in regards to with reference to the Reserve Bank of India's master action on facility for exchange of notes and coins. Consider the following statements. So there was a master action that was released in regards to the exchange of notes and coins, that at one time by a customer how much notes and coins can be exchanged. So up to 20 soil notes subject to maximum value of 5,000 per day shall be exchanged by the bank immediately at the counter free of charge. So this is correct. If the number of soil notes goes beyond 20 or the total value goes above 5,000 in a day, the bank will give a receipt and the credit of the value within a maximum period of 7 days. Small finance banks are partially exempted from the mandatory exchange of mutilated notes or the imperfect notes during their first 5 years of operation or only first 2 years of operation. Up to 10 mutilated and imperfect notes shall be exchanged by the bank immediately at the counter free of charge. So all the statements are correct, only the third one is wrong, and that's why the right answer is 1, 2 and 4, because you had to tell the correct statements. So the right answer here is C. So basically, as per the master direction for the exchange of soil notes and such, up to 20 notes subject to maximum value of 5,000 shall be exchanged by the bank immediately at the counter. If the number of notes is beyond 20 or the value is beyond 5,000, then a maximum period of 7 days can be taken for the credit of money. Mutilated and imperfect notes up to 10 notes shall be exchanged by the bank immediately at the counter. Beyond that, the credit of money will happen in the maximum period of 30 days. Now the small finance bank and the payment bank are given partial flexibility as they are not mandatorily required to exchange mutilated or imperfect notes. The small finance bank has this flexibility if they are in the first 2 years of their operations. Okay? Now coming to the next question, which of the following coin denominations has ceased to be legal tender in India and therefore is not required to be accepted by the bank branches? Try to answer this question now, that which of the following coin denominations has stopped to be the legal tender in India and therefore it is not required to be accepted by the bank branches. 25 paise and below has ceased to be the legal tender, and that's why the right answer here is D. Very good. So no bank branch can refuse to accept coins of denominations 50 paise, 1 rupee, 2 rupee, 5, 10, 20, but the coins of 25 paise and below have ceased to be legal tender. Okay. Coming to the next question, with reference to the risk management and interbank dealings revised directions, consider the following actions by the authorized dealer. So authorized dealer bank shall not offer non-deliverable derivative contracts involving INR to the resident and the non-resident. Authorized dealers can undertake any foreign exchange derivative contract involving INR with their related parties. Authorized dealers shall not allow the rebooking of any foreign exchange derivative contract if it has been cancelled. So basically, under the risk management and interbank dealing, the RBI has released the norms that the authorized dealer banks, they should not be allowed to offer non-deliverable derivative contracts involving the INR, because these kind of non-deliverable contracts, they are leading to speculative actions, or it is leading to the speculation on the depreciation of rupee, on the depreciation of rupee. So basically, authorized dealer banks cannot offer non-deliverable derivative contracts involving Indian rupees. So this is absolutely correct, and this decision has been taken to like control the speculation on the depreciation of rupees. Okay, authorized dealers can undertake any foreign exchange derivative contract involving INR with their related parties. No, authorized dealer banks, they cannot undertake such kind of derivative contracts with their related parties. Authorized dealers shall not be allowed to rebook. So even if, let's say, authorized dealers, they are allowed to offer deliverable derivative contracts involving the INR where the Indian rupees are actually delivered, and these kind of contracts are usually used for the hedging purpose, not for the speculation. These kind of deliverable contracts are used for reducing your risk, not for speculation. But let's say there is the cancellation of the contract and then there is rebooking of the contract that is happening. That means that these kind of contracts, deliverable contracts, are also being used for speculation. That's why it has been said that you cannot cancel it and rebook it. So first and third statements are correct. Second statement was wrong, and that's why the right answer here is 1 and 3, that is B. Yes, very good everyone. So let me reiterate that the idea is that the authorized dealer bank, they shall not offer the Indian rupee non-deliverable derivative contracts, because these non-deliverable contracts, they are being used for the speculative purposes on the depreciation of rupee. Okay. To residents or to non-residents, these kind of non-deliverable derivative contracts cannot be provided. Deliverable derivative contracts can be provided because they are delivering the rupee actually, and they are used for the hedging purposes to reduce the risk. But if there is the cancellation of contract and rebooking of the contract that is happening, then even these kind of cancellation and cancellation can be allowed, but the rebooking will not be allowed then. So even under the permitted hedging contracts, that is the deliverable derivative contract involving INR, users cannot take opposite positions or they cannot cancel the positions in the non-deliverable derivative markets. Okay? As well as after cancellation, the rebooking is not allowed. After cancellation, the rebooking is not allowed. And with the related parties, the authorized dealer banks, they shall not undertake any INR foreign exchange derivative contract with related parties. These are certain restrictions that have been imposed on the authorized dealer banks. Now coming to the next question. Sorry for that. In April 2026, benchmark issuance strategy has been developed by the Reserve Bank of India to improve the liquidity and reduce fragmentation in the state government securities market. RBI has decided to introduce the benchmark issuance strategy on a pilot basis, that is for a number of states only, involving how many states? So basically what happens that in the central government securities, in the central government bonds, there is the timeline, 14 days, okay, or the 91 days, 182 days for the treasury bills, 3 years, 5 years, 10 years, 20 years or 30 years for the dated government securities. But in the state government securities, the timeline was not fixed. Some states were releasing it for 2.2 years, 2.5 years, 3 years, 3.8 years, 3.9 years, 10 years, 11 years, 12 years. Like according to their need, they were releasing it in whichever tenure they wanted. As well as there was also not a set calendar on which the securities were released. This was leading to the fragmentation of the market, and the investors, they were not very like clear about the state government securities, that what is the exact tenure that will be released next. Okay, so this was leading to confusion, and that's why the RBI issued the benchmark issuance strategy, saying that the tenure will be decided, that there will be exact tenures will be decided. Like for the government securities, central government securities, there are exact tenures, 14 days, 91 days, 182 days, 3 years, 5 years, 10 years, 20 years. Similarly, for the state government securities also, the tenure, exact tenure will be decided, as well as there will be the pre-announcement of the release cycle. There will be the schedule will be released for the state government securities. Okay? So this kind of benchmark issuance strategy is released on the pilot basis involving 9 states. This is the idea. Very good, everyone. So currently, state governments and union territories borrows by issuing state government securities of multiple different tenures, leading to fragmented bond market structure. The investors, they do not have the clarity that when the bonds will be released, of what tenure the bonds will be released and such. So now the benchmark issuance strategy has been released, that rather than having the random durations, there will be set durations for the state government securities also. And this benchmark issuance strategy is launched for the 9 states for now. There will be also the release of the indicative calendar prepared in consultation with these 9 states for their market borrowing for the first quarter. Okay. Now coming to the next question, as per the RBI reporting instructions for authorized dealer category 1 banks, what is threshold below which reporting of over-the-counter foreign exchange derivative contracts involving INR may be optionally exempted? So think about it, that the authorized dealer category 1 banks, we have just discussed it, that can they do the foreign exchange, derivative contract involving the INR with their related parties? Can they do such kind of contracts? No, right? Authorized dealer category 1 banks, they shall not undertake any foreign exchange derivative contract with related parties. Okay? So this is the limitation. But the authorized dealer category 1 bank actually has to report. Now these related parties, they are doing the foreign exchange derivative contract involving INR with the other authorized dealers. Okay, so this is the idea, that the authorized dealer category 1 bank with its own related parties, it cannot do such kind of contracts. So the related parties, they can do such contracts with the other authorized banks. Now the RBI has released the reporting instructions that the authorized dealer category 1 banks, they have to report all the foreign exchange derivative contracts involving the INR that are undertaken by the related parties with any entity with any entity, this has to be reported by the authorized dealer category 1 bank in the trade repository of the CCIL. Okay? So the reporting instructions have been released by the RBI that the authorized dealer category 1 banks, they have to report all the foreign exchange derivative contracts involving INR that is happening in the over-the-counter market. So for the related parties, that have to be reported in the trade repository of the CCIL. And the timeline has also been mentioned, but it has been said that these kind of transactions can be optionally exempted if they are up to USD 1 million. If they are up to USD 1 million, not 10 million, it is USD 1 million. USD 1 million. So basically the Indian authorized dealer category 1 banks, they must report the INR linked over the counter foreign exchange derivative contracts that is done globally by their related parties. So whatever related parties they are doing the over the counter foreign exchange derivative contracts, that has to be reported to the trade repository of the CCIL by the authorized dealer category 1 bank. The related party may also report the details of such derivatives undertaken by it independently to the trade repository of CCIL. Transactions that are exempted from reporting back-to-back arrangement, that is authorized dealer category 1 bank. See, authorized dealer category 1 bank, it has to report its own transactions as well as the transactions of the related party. So if the authorized dealer category 1 bank is undertaking back-to-back arrangement, or let's say the related party is doing the transaction with some other authorized dealer category 1 bank, so these kind of transactions are not necessarily reported, because if the related party is doing the transaction with the other authorized dealer category 1 bank, so that will report it to the trade repository of CCIL. Okay? So basically this all we have discussed in the session which I took regarding the reporting instruction released for the authorized dealer category 1 bank. Authorized dealer category 1 bank, yes, authorized dealer category 1 bank, it has to report all the over-the-counter foreign exchange derivative contracts that it is doing itself in the trade repository of CCIL, and for the related parties also it has to be reported to the trade repository of CCIL. Now the authorized dealer category 1 banks, if they are doing the back-to-back transactions, that means they are basically providing the transaction to the client and they are also having the transaction that is closing the transaction with some other entity. So back-to-back transaction do not have to be reported to the trade repository, and the related party is doing the transaction with another authorized dealer. The authorized dealer whose related party it is, they do not have to report it separately, because the authorized dealer with which the transaction is happening, that will report it itself. So if the related party is of the authorized dealer category 1 X and the transaction is happening with Y authorized dealer, so Y will report it. The X whose related party it is, it does not have to. As well as the authorized dealer category 1 bank shall have the option of not reporting transactions where the notional value of the contract does not exceed $1 million. Now coming to the next question, that with reference to the phased reporting requirements, the authorized dealer category 1 X has to report the transactions of the related parties that the related party is doing with the other entities that are not the authorized dealer basically. So with the other parties, if there is any transaction that is happening of the related party, that has to be reported. Now with effect from July 1, 2027, all such transaction that is undertaken by the parent of this authorized dealer category 1, including the branches of the parent, that have to be reported by the authorized dealer category 1 bank. So that is correct for the over-the-counter foreign exchange derivative contracts. With effect from July 1, 2027, transactions reported, these kind of transactions should be reported by the authorized dealer category 1 if in case 70%, in case that constitutes 70% of the notional value of such contracts. Okay, if the transaction is by the related party other than the parent. So that is correct by July, that is 70% is correct here. So by July 1, 2027, if the parent or the branches of the parent, if they are doing the over-the-counter derivative transaction, the foreign exchange derivative transaction involving the INR, so the authorized dealer category 1, whose related party it is, it has to report it by 1st July 2027. In case of the other related parties, which is not the parent, in this case, with effect from 1st July 2027, only 70% of the transactions have to be reported. By January 1, 2028, 80% of the transactions have to be reported, and by July 1, 2028, all such transactions undertaken by the related parties have to be reported. Okay, so first and third are correct, second is wrong, and that's why the right answer here is C. Sorry, incorrect statement you have to tell, so the right answer here is E. Okay, incorrect statement is 2 only, so E is the right answer. So this is the idea that authorized dealer category 1 bank has to report the over-the-counter derivative transactions of the foreign exchange involving the INR. In case of parent and its branches, the reporting should be 100% from July 1, 2027. In case of the other related parties, the reporting should be first 70%, then 80%, then 100%, and the timeline should be July 1, 2027, January 1, 2028, and July 1, 2028. By this, 100% of reporting of the related parties over the counter derivative transactions involving the INR should also be reported. Okay. Now coming to the next question, that RBI has recently released Reserve Bank of India Commercial Banks Undertaking of Financial Services Amendment Directions 2026. Which of the following statements is incorrect in regards to the directions and the amendment? Try to read the question and try to answer this question. Now RBI has recently released the amendment directions. Which of the following statement is incorrect in regards to the amendment directions? The regulated entity shall not individually contribute more than the regulated entity shall not individually contribute more than 10% of the corpus of the alternative investment fund. Correct. The aggregate contribution of all the regulated entities in any alternative investment fund shall not be more than 50% of the corpus. No, 20% of the corpus, right? So this is the incorrect statement. If a regulated entity holds more than 5% in the alternative investment fund and the alternative investment fund is investing in the borrowing entity of the same bank, then the bank has to maintain the provisions of 100%. Okay, so this is the idea that, see, basically the individual regulated entity, see, for the regulated entities, banks, NBFCs, there are certain rules and regulations that individually they cannot invest more than 10% in an alternative investment fund, and in aggregate they cannot invest more than 20% in the alternative investment fund scheme. If, let's say, a regulated entity is holding more than 5% in the alternative investment fund, and the alternative investment fund is investing in the borrower entity of this regulated entity, that means there is indirect investment that is happening in the borrowing entity debt instrument. So the regulated entity, the bank, has already given the debt of 100 crores to this borrower, and now the alternative investment fund is using the investment of the regulated entity to further invest in the debt instrument of this borrower, so further providing the debt to this borrower. So in case the regulated entity is investing more than 5% of the corpus of the alternative investment fund, and the alternative investment fund is investing in the debt instrument of the borrower entity of this bank, in this case 100% of provisions have to be maintained by the bank, by the regulated entity, in regards to the investment that has happened. Okay. Now, this is also correct. If a regulated entity invests in subordinated units of the alternative investment fund, which is more risky, so in this case, these kind of subordinated units, they have to be deducted from the capital base, from the tier 1 and tier 2 capital. The RBI has now exempted Agri-Sure from the above norms governing the investment in alternative investment fund. So all the other statements are correct, only the B was incorrect. So regulated entity shall not individually contribute more than 10% of the corpus of alternative investment fund. In aggregate, they cannot invest more than 20%. If a regulated entity holds more than 5% in the alternative investment fund, which subsequently invest in the borrower of the same bank, then the bank has to maintain 100% of provisions on such exposure. Okay. Now, RBI has now exempted Agri-Sure from the above rules and regulations. So Swami, that is a special window for affordable and mid-income housing investment fund, and the Agri-Sure, they both have been exempted. So before, Swami was exempted from the norms. Now the Agri-Sure has also been exempted from the norms. So recently the Agri-Sure has been exempted from the norms of investment in the alternative investment fund. Okay. So the regulated entities individually can invest more than the limit, or in aggregate they can invest more than the limit. The norms above are not applicable for the Agri-Sure alternative investment fund. Coming to the next question. all recurring. Consider the following statements regarding the transaction limit. Okay, so all the recurring transactions may be authorized without additional factor authentication up to 30,000 per transaction. Payment of insurance premium, subscription to mutual funds, credit card bill payments may be made without additional factor authentication up to 1 lakh per transaction. Pre-transaction notification is not required for e-mandates registered to auto-replenish balances of FASTag and NCMC, National Common Mobility Card. Which of the above statements is or are correct? That you have to tell. Yes, C is the answer. That is second and third are correct. Absolutely correct. Here, instead of 30,000, it should be 15,000. So basically the digital payments e-mandate framework was released, in which it was said that the transaction limit, all recurring transaction may be authorized without additional factor authentication up to 15,000 per transaction. For the payment of insurance premiums, subscription to mutual funds, and credit card bill payments, they may be made without AFA up to 1 lakh per transaction. The transaction notification that has to be sent 24 hours before the transaction is not required for e-mandates used for auto replenishment of the FASTag and the NCMC balances. Okay. Now coming to the next one, the fourth edition of the Reserve Bank of India's Global Hackathon, Harbinger 2025. This was organized last year around which of the following themes? And this year the result has been released. In April 2026, the result has been released, and that's why this is again in news. This is again in RBI website in the RBI press releases. Okay. So what is the theme of the Global Hackathon Harbinger 2025, under which the RBI has given 3 problem statements and has requested the innovative solutions, and the winners also get hefty prizes, good prizes. So the theme for the Global Hackathon Harbinger 2025, very good. E. Secure banking powered by identity, integrity, and inclusivity. Remember that the Global Hackathon Harbinger 2025 has the theme Secure banking powered by identity, integrity, and inclusivity. And there were 3 problem statements, that is tokenized KYC, offline central bank digital currency, and enhancing trust, for which the innovative solutions were received, and there are the winners. Now, which team has won the Best All-Women Team Award at RBI's Global Hackathon Harbinger 2025 for developing an AI-based grievance redressal platform for Divyang customers, senior citizens, and users with low digital literacy? So, which was the Best All-Women Team? Team Vishwas, Team Nidan, Team Samvat, Team Pragati, Team Saksham. Which was the best all-women team? Yes, it was Team Nidan. So best all-women team, a team comprising of only women across all the 3 problem statements. So they were the winner. So Team Nidan, they have developed the AI-based grievance redressal platform designed for certain customers. Coming to the next question, the RBI has recently released the RBI Non-Banking Financial Companies Branch Authorization Amendment Directions 2026. Which of the following statements is incorrect in regards to the amendment directions? Try to answer this question. So most of these topics we have already discussed in the Finance 360-degree session. So if you want to know about a topic in detail, you can see the Finance 360-degree sessions. Okay, so we have discussed the NBFCs related directions in detail in the Finance 360-degree session regarding urban cooperative banks. Whatever updates are coming, we have discussed this in detail in the Finance 360-degree session. So now, in regards to the branch authorization, which of the following statement is incorrect in regards to the amendment directions? NBFCs must give at least 3 months public notice before closing any branch or office. Absolutely correct. If a deposit taking NBFC or the deposit taking housing finance company under the category of NBFC publishes public notice of closure in newspapers that it is closing down its branch or office, it must inform the RBI or the National Housing Bank within 7 days. Absolutely correct. NBFCs with net owned fund less than or equal to 50 crore, they are restricted to the state where its registered office is located. Yes, correct. They cannot open branches outside the state where their registered office is located. Absolutely correct. Net owned fund more than 50 crore and credit rating of AA or above can operate across India. Okay? Only those NBFCs excluding core investment company and housing finance company that already had foreign branches and had informed RBI earlier can continue them. Yes. So only the incorrect statement is D. because it should not be BBB minus, it should be AA. Okay, so NBFC, so D is the answer here. Yes. An NBFC is generally permitted to open branches without having the need to obtain prior approval from RBI within India, unless specifically restricted. As a general rule, NBFCs are allowed to open branches as a general rule, NBFCs are not allowed to open branches outside India. Only those NBFCs which already had their branches previously with the information to the RBI, they can continue them, excluding the core investment company and housing finance company. Closure of branches, at least 3 months public notice should be there, and the RBI has to inform within 7 days in case of deposit taking NBFC. The NBFCs, they are not allowed to open their branches in the other countries, but they are allowed to open their representative office, which are not undertaking any kind of transaction, which is only doing the market research, which is only doing the market studies, or the license activities, that is communication and such. The parent NBFC must regularly get reports from the representative office. Now, the applicability of these provisions are for the deposit-taking NBFCs, core investment companies, investment and credit company, factor, microfinance institutions, infrastructure finance company, infrastructure debt fund, and housing finance company. Now, net owned fund, if a deposit taking NBFC has net owned fund up to 50 crore or the credit rating below A, that means if the net owned fund is equal to or less than 50 crore or the credit rating is less than A, in this case, the branches can be opened only within the state where its registered office is located. If the net owned fund is more than 50 crore and there is also the credit rating of A or above, then the branches can be opened or the agents can be anywhere in India. Next is the question on the half-yearly report on management of foreign exchange reserves, October 2025 to March 2026. Which of the following statements is or are correct? So, half-yearly report on management of foreign exchange reserves. Try to answer this question. We have discussed this in Finance 360. For the course students, we are going to discuss it in the reports section. Okay? Okay, try to answer this question. The valuation gain primarily reflecting higher price of gold. See, there is a valuation gain. Valuation gain basically in the foreign exchange reserves. Whatever foreign exchange reserves the central bank has, in that the value has increased because of the increase in prices of gold. In the foreign exchange reserves, the RBI also hold the foreign currency assets such as euro, pound sterling, Japanese yen, dollars. Okay, so dollar has depreciated against the major currencies such as euro, pound sterling, Japanese yen. So because of the dollar depreciation, these currencies have become stronger. So foreign currency asset has also improved, or the value of the foreign currency asset or the value of the foreign exchange reserves has improved because of the depreciation of dollars and the strengthening of the euro, pound sterling, and the Japanese yen, which are the other strong currencies, other major currencies that are also held in the foreign exchange reserves. Lower bond yields means higher bond prices that is held by the RBI. So because of all of this, the valuation gain has happened in the foreign exchange reserves that has increased to USD. So because of the valuation gain, the foreign exchange reserves increased to US dollar 50 increased to, like, the valuation gain was $50.2 billion in this time period. The foreign currency asset comprise multi-currency assets. Like in the foreign currency asset under the foreign exchange reserves, the RBI is holding dollars, euro, pound sterling, Japanese yen, and other currencies also. They are held in multi-asset portfolios with the securities as the highest holding. With the securities. See, if the RBI is holding the foreign currency asset, RBI is holding the foreign currency, RBI is not holding the currency as such. RBI will invest this currency in the different securities like the sovereign debt instruments or the other instruments that are backed by the governments of the different countries. So securities as the highest holding, followed by the deposits with the central banks and BIS. That is correct. RBI is permitted to invest up to 5 billion in bonds issued by the India Infrastructure Finance Company. So this is wrong. Not 1 billion, 5 billion. Okay. So 1 and 2 is the right answer. Here the correct statements were asked. So 1 and 2 is the right answer. That's why E is the right answer. So basically on the balance of payment basis, there is current account, there is capital account that we have discussed. So there was deficit in the current account, capital account, and that's why the balance of payment. On the balance of payment basis, the foreign exchange reserves decreased by $30.8 billion, but there was the valuation gain of $50.2 billion. So that's why in nominal terms, including the valuation gain, the balance of payment, because of the balance of payment, foreign exchange reserves decreased by $30.8 billion. Because of valuation gain, foreign exchange reserves increased by $50.2 billion. So in total, there was the net foreign exchange reserves change of $19.4 billion. So in nominal terms, including valuation effects, the foreign exchange reserves increased slightly by $19.4 billion. Okay. Now, the foreign currency asset that is kept in the foreign exchange reserves, they are invested in the securities, like the major 84.31% of the foreign currency asset, they are invested in the securities. Then the second highest is the deposits with the other central banks and BIS. Now, the law broadly permit the following investment categories for the foreign currency asset. It can be invested or it can be deposited with the other central banks or with the Bank for International Settlement, deposits with the commercial bank overseas. The foreign currency asset can be invested in the securities such as the debt instruments representing the sovereign bond, sovereign guarantee liability, not exceeding 10 years. Okay? Other instruments or institutions as approved by the Central Board of the RBI. The RBI has the mandate to invest up to $5 billion in the bonds issued by the India Infrastructure Finance Company UK Limited, but RBI has only invested 400 million till now. Now coming to the next question, try to answer this question. As per the half-yearly report on management of foreign exchange reserves under the revised SHARK currency swap framework, which of the following countries has a swap arrangement with RBI where they have taken the rupees against their local currency or they have taken dollars against their local currency from the RBI? So RBI has provided the help to which countries under the SHARK currency swap framework till now? So it is, yes, correct, Bhutan and Maldives. Very good. Now coming to the next question. If you want to know more about the half yearly report, I have taken a detailed session. You can see that. Okay. Now coming to the next question. That is under the Reserve Bank of India, non-banking financial companies registration exemptions framework for scale-based regulation amendment directions. If the NBFC is not availing the public funds, it is not having the customer interface, if it is having the asset size of how much, will it be exempted from the registration requirement as the NBFC and the requirement of reserve? It will be exempted from these requirements if it has the asset size below 1000 crores. Very good. So we have discussed, like this is also discussed in Finance 360-degree session also, that the NBFCs are divided into type 1 and type 2 NBFCs. Type 1 NBFCs are such NBFCs that are not availing the public funds, that are not having the customer interface, and they will be unregistered if they have the asset size of less than 1000 crore. Okay, that means they do not have to be registered as the NBFC, and they do not have to maintain the reserves or the net owned fund. Now, type 2 NBFC is the NBFC that is having the public funds or that is having the customer interface. Okay. So if the NBFC does not avail the public funds, has no customer interface, has an asset size of less than 1000 crores, it will be exempted from the requirement of registration, net owned fund, and the requirement of reserve fund. Now coming to the next question, this is more of a static kind of question, that if like in the upper layer, the NBFC will be kept only if it is under certain, like if it is kept by the RBI under the upper layer. So the NBFC will be kept in the upper layer according to certain methodology. So what is this methodology? What is the weightage under this methodology? See, the size and leverage has the highest weightage. That the larger the NBFC, the bigger the leverage it has in the market, the more riskier it can be. Okay, so size and leverage has 35% of the weightage, interconnectedness has 25% of the weightage, and the rest has 10% of the weightage. So here, which of the pair is correct? Segment penetration 10% weight, group structure 10% weight, size and leverage and interconnectedness, they are wrong. Nature and type of liabilities 10% of weight. So 1, 2 and 5. 1, 2 and 5 is correct. So here remember this, that the methodology is such that there is size and leverage that is seen, the interconnectedness complexity is seen, segment penetration, then there is nature and type of liabilities, and group structure. Now these three, size and leverage, interconnectedness, complexity, they show the quantitative factors. The segment penetration, nature and type of liabilities, and the group structure, they show the qualitative factors. Size and leverage, interconnectedness, they have the highest percentages of 35% and 25%. The rest have 10% of weight. Okay? So the NBFCs, they are divided into base layer, middle layer, upper layer, and top layer. So if an NBFC is kept in the upper layer, it has to follow higher rules and regulations, and on the basis of the methodology, the NBFCs can be kept in the upper layer if they have some risk in the market and such. Okay. Now coming to the next question regarding the urban cooperative banks. As per the RBI's amendment directions on urban cooperative banks concentration risk management 2026, which of the following statement is or are correct? That you have to tell. As per the RBI's amendment directions on the urban cooperative banks, which of the following statements is or are correct? The aggregate unsecured loans and advances granted by a urban cooperative bank shall not exceed 20% of its total loans and advances. Absolutely correct. If a urban cooperative bank meets the eligibility criteria for business authorization, then unsecured loans up to 50,000 per borrower, if they qualify for the priority sector loans, they will not be included in the 20% limit. They will be excluded from the 20% limit on the unsecured loans and advances. Correct. Urban Cooperative Bank may grant loans to nominal members for purchase of consumer durables. So yes, Urban Cooperative Bank can grant the loans to nominal members for the purchase of consumer durables, subject to a maximum of 2.5 lakh. So not 5 lakh, it is 2.5 lakh. So 1 and 2 is correct, and that's why the right answer here is A. Okay, any confusion, anyone? So the aggregate, the total unsecured loans and advances that a urban cooperative bank can provide is limited at 20% of the total loans and advances. If a urban cooperative bank is meeting the eligibility criteria for business authorization, unsecured loans up to 50,000 that are per borrower, if they qualify for the priority sector loans, they will not be included in this 20% limit. Urban cooperative bank also can give loans to the nominal members for the consumer durables, but to a limit of 2.5 lakh. Okay. So this we have recently discussed in the Finance 360-degree session also. In the course also we have discussed this. In the live class also we have discussed this. So I'm not going to go too much in depth, but this just read through it once so that you have the clarity. Okay. Now coming to the next question. In the context of the Reserve Bank of India Urban Cooperative Bank Concentration Risk Management Directions 2025, what is the maximum exposure limit of an urban cooperative bank to a single borrower? How much of the maximum exposure a urban cooperative bank can have to a single borrower? So this is from the static. Try to answer this if anyone knows. Or see, such kind of static questions, 1 or 2 static questions can also come. So if you are not aware about it, you will have to leave it. Okay. So try to answer this. So for the single borrower, 15% of tier 1 capital, and for the group borrowers 25%. So the exposure to an individual borrower, so the total exposure, secured, unsecured, doesn't matter. The total exposure to an individual borrower does not exceed 15% of the tier 1 capital, and the exposure, the total exposure, secured or unsecured, basically it is secured mostly, to a group of connected borrowers or parties does not exceed 25% of the tier 1 capital. Okay. With reference, now the small value loans were quite in use in the previous year. The small value loans were quite in use in the previous year. Now also they become important because it was said that at least 50% of aggregate loans and advances of the urban cooperative banks, they must comprise small value loans by 31st March 2026. A small value loan is defined as a loan up to 25 lakh or 0.4% of the tier 1 capital, whichever is higher. So the maximum permissible limit per borrower under the small value loan is 3 crore. Okay, is 3 crore. So first and second statements are correct, but the third one is Wrong. And that's why the right answer is 1 and 2. And remember that the static 1 or 2 question can come from static. If you know, very good. If you don't, then you will have to leave it. Okay. 80 out of 80 is not the target in the exam. The target is to do 40, like 35 to 40 questions. So do not waste your time on such questions that you do not know. Okay? So the UCB shall have at least 50% of its aggregate loans and advances comprising of small value loans, that is loans of value not more than 25 lakh or 0.4% of its tier 1 capital subject to the ceiling of 3 crore. The small value loans in aggregate loans, it was said that at least 50% of the small value loans in the aggregate loans should be there. Okay? Chalo. Now coming to the next question. This is important. Recent update has happened, and this is the last question. This is the last question from the RBI notifications, RBI press releases. Now, after this, we will move forward with the finance current affairs. Okay. So, which of the following statements is or are incorrect in regards to the Reserve Bank of India Urban Cooperative Banks Credit Facilities Amendment Directions 2026? Try to answer this. For Tier 1 and Tier 2 UCBs, a housing loan can run up to 20 years in total. And this 20-year already includes the moratorium period. So this is correct that for Tier 1 and Tier 2 UCBs, a housing loan can run for up to 20 years in total. And this 20-year already includes the moratorium period in which the EMIs are not coming in such. The bank can give a moratorium only till the house is built, but it cannot go beyond 12 months from the first loan disbursement. It cannot go beyond 24 months. It cannot go beyond 24 months. A Tier 2 UCB can give unsecured loans to a single borrower up to a limit of 7.5 lakh. Correct. The Tier 1 UCB can give unsecured loan to a single borrower up to a limit of 5 lakh. The Tier 2 UCB can give unsecured loan to a single borrower up to the limit of 7.5 lakh, and the Tier 3 and the Tier 4 UCB can give unsecured loans to a single borrower up to the limit of 10 lakh. So 1, 2 and 4 statements are correct. First, third and fourth statement are correct. Okay. So the right answer here is E. Yes, very good. So this is the idea that for Tier 1 and Tier 2 UCBs, a housing loan can run up to 20 years in total, including the moratorium period. The moratorium period should not be more than 24 months, and the moratorium period should only be provided for the construction of the houses. Next is that the Tier 1 UCBs can provide the unsecured loan to the single borrower up to the limit of 5 lakh. Tier 2 UCBs can provide the unsecured loans up to the limit of 7.5 lakh to a single borrower. Tier 3 and Tier 4 can provide the unsecured loan up to the limit of 10 lakh to a single borrower. And the UCBs are divided in the Tier 1, Tier 2, Tier 3 and Tier 4 on the basis of their deposit size, as well as Tier 1 UCBs also are the unit UCBs that they are only present in one district at one place, and the salary earner UCBs that has the salary earner employees from a particular institution or group of institutions. Okay. So Tier 1 UCBs are the small UCBs, all unit UCBs, salary earner UCBs, irrespective of deposit size, and all other UCBs having deposit up to 100 crore. Tier 2 UCBs with deposit of more than 100 crores up to 1000 crores, and so and so. Now coming to the finance current affairs of April 2026. Any confusion anyone has in the RBI notifications, RBI press releases? Out of 35, how many questions were you able to answer? Were you able to answer 25 plus, or were you able to answer 25? So if you are able to answer 25 plus, that means you have done the revision, you are going in the right direction. If you were not able to answer 15 plus, that means the revision is required. Revision is required. Okay. So that is the idea. Okay. So 25 plus means you are going in the right direction, you are doing the revision. Just try more and more questions so that the mistakes that you are doing right now, you do not do it in the examination. If you are getting 15 plus only, that means you need to do the revision that is lacking. Now coming to the finance current affairs revision of April 2026. Now we will go rapid fire because the topics are small only. So which organization is the sponsor for the Antariksh Venture Capital Fund, India's first dedicated space tech investment fund operationalized in April 2026? So which organization is the sponsor for the Antariksh Venture Capital Fund? So this is the India's first dedicated space tech investment fund where the money will be taken from the sophisticated investors and the money will be invested. So money will be taken by the Antariksh Venture Capital Fund. This will pull in the investment from the sophisticated investors and this money will be invested in the startups that are building the space technology, especially the technology that has the readiness level of 4 and above. Okay. So who is the sponsor for the Antariksh Venture Capital Fund? SIDBI Venture Capital Limited is the sponsor. Very good. So recently India operationalized its first ever dedicated space tech investment fund called Antariksh Venture Capital Fund. Objective is to invest in Indian space startups that have technologies at technological readiness level 4 or higher, meaning their ideas have already been tested and shown in work in a lab. Okay. So Antariksh Venture Capital Fund is a SEBI registered alternative investment fund which will collect the money from the sophisticated investors. The key investor being Indian National Space Promotion and Authorization Center. Remember this, that the key investor in this Antariksh Venture Capital Fund is the Indian National Space Promotion and Authorization Center in space, and the fund is sponsored by SIDBI Venture Capital Limited. That is the idea. Now try to answer this question in the context of Indian natural gas derivative contracts launched in April 2026. These contracts are linked to which of the following indices? Just a second, let me. Okay. So recently the Indian natural gas derivative contracts have been launched, so that right now you can come in a derivative contract, you can set a rate so that you can purchase this you can purchase the natural gas in the future, in a future date. Let's say after 3 months you know that you will need a lot of the natural gas equipments and such, so you can come in a derivative contract right now, you can come in the futures contract right now and you can set the rate. So this rate will be decided, or which indices will be followed. The gas index of India will be followed. That means this is a benchmark index on the basis of which the rate will be decided in the derivative contract, and this benchmark index is the index of India only. So basically in April 2026, the National Stock Exchange in collaboration with the Indian Gas Exchange, remember the collaboration between the National Stock Exchange and the Indian Gas Exchange, launched Indian natural gas derivative contracts. These are the financial instruments that allow participants to lock in the price of the natural gas for the future transactions. The Indian natural gas derivative contract, they are linked to the gas index of India, that is the price index on the basis of the domestic market conditions. Okay? So gas index of India is a domestic benchmark index developed by the Indian Gas Index, developed by the Indian Gas Exchange. Now coming to the next question, which regulatory body has launched the verified app label initiative? So in the Google Play Store, the apps that you can see for the stock trading that has a verified badge, if they are verified and they are the intermediaries or they are the registered with the SEBI. So you can see the verified app label initiative, or you can see the verified app label, that is the initiative under the SEBI. So this is the idea. So SEBI launched the verified app label initiative. The objective is to protect the investors and to have the verified label, to have this verified label for the stock trading apps, so that through the authentic apps you do the stock trading. Next is, recently SEBI has granted a one-time relaxation related to IPO timelines and minimum public shareholding norms. SEBI has granted a one-time extension for validity of observation letters till when? So when the observation letter, that is the formal agreement by the SEBI or the formal communication by the SEBI that okay, this IPO can be launched. So with the release of the observation letter within 12 months, the IPO should be released, or with the release of the observation letter, maximum there can be the extension of time can be provided of 18 months for certain cases. Till then the IPO has to be released. So the IPO that had to be released between April 2026 till September 2026, for these particular IPOs the extension of time has been provided that by 30th September 2026 they can release their IPO, okay, without any further documentation and such, if they already have got the observation letter. So basically, the idea is that if the observation letter is provided, within 12 months, generally in the usual case, within 12 months, the IPO has to be released. An observation letter is the formal communication by the SEBI that the IPO can be released by this company. The SEBI has seen that the disclosures have been made by the company and the IPO can be released. So within 12 months, the IPO has to be released. Now the IPOs that had to be released between April to September, for them, the timeline has been provided that till 30th September, they can release the IPO. So if you had to release the IPO by 1st of May or by 10th of May, so now you can release your IPO by 30th of September 2026. So this is the 6-month extension of timeline that is provided. Okay. So minimum public shareholding, that is 25%. Minimum public shareholding of the listed company should be there. So for them also, the extension of timeline has been provided. This is it. Next is, with reference to the methodology adopted for identifying domestic systemically important insurers in India, which of the following indicators are taken into consideration by the regulator? So there are the 3 domestic systemically important insurers that have been identified by the Insurance Regulatory and Development Authority of India, that is the LIC, GIC and the NIACL. So now what is the methodology that is used? The size of operations measured through total revenue. This is seen. The global activities across more than one jurisdiction. Employee strength and branch network of insurer? No. Lack of substitutability of the insurer's products and services? Yes. Interconnectedness arising from counterparty and the macro financial exposures? Yes. So 1, 2 and 4 and 5. These are the indicators that are seen to select the domestic systemically important insurers that are the too big to fail insurers, and these too big to fail insurers are LIC, NIACL and the GIC. Okay, these are the too big to fail insurers. Now, Jan Vishwas Amendment of Provisions Bill 2026, which seeks to decriminalize minor offences by replacing imprisonment with the civil penalties and administrative actions. This has been spearheaded by the DPIIT under which ministry? Now, if you know that this department is which department, you will be able to identify the ministry very easily. So this Jan Vishwas Amendment of Provisions Bill 2026 is being spearheaded by which ministry? It is being spearheaded by Ministry of Commerce and Industry, and the DPIIT is the Department for Promotion of Internal Industry and Internal Trade. So Department for Promotion of Industry and Internal Trade. Okay. So this is the idea that Jan Vishwas Amendment of Provisions Bill 2026. This is aimed at decriminalizing minor offences across various laws, replacing criminal prosecution and imprisonment with the civil penalties. And this basic amendment has been spearheaded by the Ministry of Commerce and Industry, Department for Promotion of Industry and Internal Trade. Coming to the next one, that which bank has recently joined the Interoperable Banking Connect platform developed under the RBI's Payment Vision 2025 to facilitate seamless net banking based digital payments. So which of the bank has recently joined the Banking Connect platform? So what happens that the payment aggregators, they connect the merchants with the customers so that the merchants can receive the payments and such. Merchants are the Amazon, Flipkart, let's say. Now the payment aggregators, they can take the money from the customers through UPI, through digital wallets, through the card, debit card, credit card, through the net banking also. Now for the net banking, there is not a single platform for the banks, and the banks, there are the different procedures that the banks follow, different banks follow. So the payment aggregators, they needed to separately, single-handedly had ties with all the banks so that the net banking access can be provided to the customers, and through the net banking also the customers can pay. Now the payment aggregators, the Banking Connect platform has been launched, and the payment aggregators, they just had to integrate with the Banking Connect platform, and all the banks that have connected with the Banking Connect platform, the payment aggregator can have access to such net banking platform of the banks. Okay, so Banking Connect platform, it provides the interoperable net banking platform through connecting, like if the payment aggregator is getting integrated with the Banking Connect platform through this, and all the banks that are part of the Banking Connect platform, so payment aggregator can get access to them. So basically Axis Bank has become a part of the Banking Connect platform recently, And Banking Connect is an interoperable net banking platform that enables seamless and faster digital payments across different banks and such. Banking Connect platform has been developed by NPCI Bharat Bill Pay Limited. The platform was launched in 2025 and Axis Bank has recently joined it. So if the Banking Connect platform is joined by multiple banks. So if the payment aggregator is getting integrated with this Banking Connect platform, the payment aggregator gets the access to the net banking of all these banks. So the payment aggregator do not have to do the separate tie-ups with each and every bank single-handedly. As well as if the Banking Connect platform is there, then through the net banking, the QR code payment can also happen, and the intent based payment can also happen. That means as soon as you click on this net banking, you will be taken to the bank's app through which you can do the net banking. Okay, so that is the intent based payment, that if you are clicking on UPI, clicking on the Google Pay, the Google Pay opens. Similarly, if you are clicking on the net banking and you have the net banking app of the bank, so you will be taken to that bank's app. So through this Banking Connect platform, the QR code payments can also happen, and the intent based payments where the native app is opening, that can also happen. Next is ULI, that is Unified Lending Interface, envisioned as a digital public infrastructure to streamline the frictionless credit delivery and the consent based data sharing. This is being developed by which of the following? So basically the ULI, that is envisioned as a digital public infrastructure to streamline the frictionless credit delivery. So which of the following is developing this? Anyone? Which of the following entities is developing this unified lending interface? RBIH, Reserve Bank Innovation Hub. Okay, so primary objective of ULI is to connect the lenders with the data service providers so easy access of the data can be taken, and the lenders can provide the loans in a faster manner with the data from the data service providers. ULI is being developed by the RBIH, that is Reserve Bank Innovation Hub, a wholly owned subsidiary of RBI. Next is that the President of India gave assent to the Insolvency and Bankruptcy Code Amendment Bill 2025 in April. And which of the following statement is correct in regards to Insolvency and Bankruptcy Code Amendment Bill 2025? This we have discussed in the Finance 360-degree session also. So try to answer this, that the liquidation proceedings must be completed in 180 days, extendable by up to 90 days. The creditor initiated insolvency resolution plan must be concluded within 120 days, within 150 days, extendable by up to 45 days. So this is also wrong. Withdrawal of an insolvency application would require the approval of 90% of voting share of the committee of creditors. This is correct, that if you want to withdraw the insolvency application, then at least 90% of voting share of the committee of creditors is required. CIRP, that is creditor initiated insolvency resolution process, can be initiated with at least 51% of the notified financial creditors agreeing to the initiation. The NCLT shall within 14 days of the receipt of the application by an order admit the application. So here only the C statement is correct, and you can read the idea. I have already provided you the idea that the IPC has been omitted and the data you have to remember. Now coming to the next question, UPI dominates India's digital payments landscape, accounting for 81% of retail digital payments in India. While India contributes what percentage of the global real-time payments? %49. Very good. So the UPI has completed its 10 years in April 2026. Now, as per the IMF, UPI is the world's largest real-time payment system by volume of the transactions that are happening. UPI dominates India's digital payment landscape, accounting for 81% of retail digital transactions in India, while India contributes 49% of global real-time payments. Okay. So now coming to the next question, that with reference to the measures related to social impact funds announced in April 2026, consider the following statement. So there are certain measures that have been taken in regards to the social impact funds and the social stock exchange. Now the minimum investment amount in social impact funds has been reduced from 2 lakh to 1,000. Non-profit organizations can remain registered on social stock exchange for a maximum of 3 years. For a period of 2 years, which is extendable by 1 year, so a maximum of 3 years, not 4. The minimum subscription requirement for zero coupon, zero principal instruments has been reduced to 50% in certain cases. That is correct. So minimum subscription requirement for 75%, that at least 75% of the informed amount. So for zero coupon, zero principal through these instruments, if the money is raised, at least 75% of this amount should be raised. That was informed, but now it has been said that for certain cases where the social stock exchange agrees, 50% can be raised. If the 50% is raised, then also this money can be taken and the bond can continue. But if the minimum subscription is not achieved of the 75% in the general cases and the 50% in the specific cases, the funds collected must be refunded. So first is correct, second is wrong, third and fourth are also correct. Okay, so the answer here is 1, 3 and 4. E. So minimum investment has been reduced from 2 lakh to 1000. NPOs, the not-for-profit organization, can remain registered for a maximum period of 3 years, 2 years in general, and with the permission of the social stock exchange, 1 year extension can be taken. Minimum subscription requirement has been relaxed from 75% to 50% in specific cases with the permission of the SSC. Refund is mandatory if minimum subscription is not achieved in the case of zero coupon, zero principal. Now, which asset management company has recently received approval from the Pension Fund Regulatory Development Authority to sponsor a pension fund under the National Pension System? So, under the National Pension System, there are different pension funds through which you can invest in the National Pension System. Now, which of the asset management company has recently got the approval from the Pension Fund Regulatory and Development Authority? So, the answer here is PPFA's Asset Management Private Limited. It has recently received approval to sponsor a pension fund. Okay, so D is the answer here. Next is in April 2026, under the MOU between the Department of Telecommunication and SEBI, which platform will be used for exchanging intelligence related to fraud detection? So Department of Telecommunication and SEBI, they have done the MOU so that the data sharing can happen, that which telecom or which numbers are related to the frauds and such. So such kind of data transfer can happen, and the data transfer or the intelligence exchange can happen through the digital intelligence platform. So B is the answer. So digital intelligence platform is dedicated platform developed by the Department of Telecommunications for sharing intelligence related to telecom misuse and fraud. So rest of this you can read. This is the main idea. Now coming to the question Parva that we have recently discussed in the Finance 360-degree session. So try to answer this question. Try to answer this question. SEBI has recognized with reference to the Parva, consider the following statements. So these are the three statements and you have to tell that which of the statements given above is or are correct. Let's see how many of you are able to answer this question. We have recently in the Finance 360-degree session, we have recently discussed about Parva. So SEBI has recognized Care Ratings Limited as Parva entity, while NSC as the Parva data center. Investment advisors, research analysts who wish to communicate their certified past performance data to clients, they must enroll with Parva by August 3, 2026. Investment advisors, research analysts, they may communicate certified past performance data to clients only up to May 3, 2029. Yes, very good, Abhi. It is only up till May 3, 2028. So the first statement is correct, second statement is correct, but the third statement is wrong. So Parva is the past risk and return verification agency which verifies the claims made by the investment advisors, research analysts, algorithm providers and such. So basically investment advisors, research analysts, they must enroll with Parva by August 3rd, 2026 and they can only communicate their certified past performance data up to May 3, 2028. Okay. Now SEBI has recognized Care Ratings Limited, that is the credit rating agency, as the Parva entity which will provide the past risk rating verification. Okay, NSE has been recognized as the Parva data center. Now the IAs and the RAs, the investment advisors, research analysts, they must enroll with Parva by August 3, 2026. and the rest we have discussed, and this we have discussed in the finance 360-degree session. So remember to go through the finance 360-degree session or just read through it. You will be able to understand it. Nothing much is given here. The credit rating agency can become the parva if they follow these guidelines, and the stock exchange can become the parva data center if these guidelines are followed. Okay. Now, what is the minimum net worth requirement to become the parva? What is the minimum net worth requirement of the credit rating agency to become the parva? 100 crore. What is the minimum net worth requirement of a stock exchange to become the PDC, Parva Data Center? The minimum net worth requirement is 200 crores for the stock exchange. The minimum timeline for which the PDC or the Parva should be working, the minimum timeline for which the CRA and the stock exchange should be working to become the entities for 15 years. For 15 minimum 15 years of existence of CRA, it can become the Parva, or 15 years of existence of the stock exchange, it can become the PDC. Okay. Now coming to the next question, match the following SEBI IT platforms with their correct features. So subcoms, it provides a centralized communication platform between the SEBI and the external entities. So A ka 2. E-adjudication portal, it provides the online platform for the notices, replies, virtual hearings in quasi-judicial proceedings. So B ka 3. The CSAC, that is Cyber Security Audit Compliance, it provides the automated analysis of cyber audit report to identify the compliance gaps. So basically, SEBI has released the 3 IT platforms, and I hope you are easily able to answer this question. A ka 2nd, B ka 3rd, and C ka 1. Coming to the next question, with reference to free cash flow to equity norms for small and medium enterprise listings on National Stock Exchange emerge, consider the following statement. So basically, the small and medium enterprises, they can get listed on the NSE emerge platform. Now for listings, they need to have the positive free cash flow to equity. Now, there are certain norms that have been provided for the free cash flow to equity. NSE has modified the free cash flow equity formula to include proceeds from issuance of share capital as a positive component. For NBFCs, net borrowings will include short and long-term borrowings in the FCFE calculation. The small and medium enterprises applying for listing on NSE emerge are required to demonstrate positive free cash flow to equity in the last 2 out of 3 financial years. So basically, see the free cash flow to equity. First, let's see the formula, then we will come to the question again. So free cash flow to equity, it includes the cash flow from operations. So cash generated, the cash that is generated from the core business operations. So whatever cash is earned, the revenue that has been generated, minus the purchase of fixed assets, that is the money spent basically on the fixed assets. Now this has been added. Proceeds from the issuance of capital. So let's say the shares have been sold to the private investors or to the angel investors, to the venture capital funds, if the shares have been sold. So the proceed from the capital, the money that the company has got, will be included in the free cash flow to equity. Net borrowing, so this is also the money that will be included because this is the money received and the interest has to be deducted. So free cash flow to equity is basically the cash available with the company for the equity holders after meeting operational, investment and the financing interest obligations and such. So free cash flow to equity is basically the cash that is generated by the company minus the purchase of the fixed assets. Now recently it has been said that the proceeds from issuance of capital will be included. Okay, so this is the idea. So NSE has modified the FCFE formula to include proceeds from issuance of share capital. Absolutely correct. For NBFCs, net borrowings will only include long-term borrowings, not short-term borrowings. So this is wrong. Small and medium enterprises applying for listing on this NSE emerge are required to demonstrate positive profits in at least 2 out of the last 3 financial years. So first and third are correct. Okay, so FCFE we have discussed. The rest of the important points also we have discussed, that the FCFE formula will now include the proceeds, that is the money that has been received from selling the share capital, to the private investors, to the angel funds, to the venture capital funds and such. And in the last in at least 2 out of 3 financial years, there should be the positive FCFE that should have been generated. Okay? The NBFC's net borrowings will only include the long-term borrowings in the FCFE calculation. Now, coming to the next question, which of the following fintech entities has received approval from the RBI to establish a wholly owned subsidiary for undertaking regulated lending activities as an NBFC? So, which of the fintech company has recently got the approval from the RBI to work as the NBFC? It is One MobiKwik Systems Limited. Okay, so Reserve Bank of India has approved the application of One MobiKwik Systems Limited for a NBFC license. And it has been said that notably the approval was granted in a relatively short time frame, under 4 months, reflecting the regulatory responsiveness to the fintech evolution. As well as Shriram Overseas Investment Limited has got the in-principle approval from the RBI to work as a primary dealer. That's it. So MobiKwik has got the license as the NBFC, and Shriram Overseas Investment Limited has got the in-principle approval as the primary dealer. Coming to the next question, only 2-3 questions are left, so try to answer them. With reference to trends in bank credit and deposit growth in India, consider the following statements. The bank credit growth in March 2026 stood higher than the deposit growth for the same period. So the credit growth is higher than the deposit growth for the same period. So yes, recently what is happening, that the credit is growing faster than the deposit growth. So there is the credit growth gap that is generated as the credit is growing faster than the deposit. Okay, there is credit that is growing faster than the deposit. So bank credit growth is faster than the deposit growth. That is correct. Deposit growth has improved from the last year. That is also correct. That the credit growth, the credit growth is faster than the deposit growth. The deposit has grown faster than the previous year, but the credit growth is even faster than the previous year. During the pandemic years, the credit growth remained higher. No. So 1 and 2 is correct. Third is wrong. And the right answer is, we have to find the incorrect statement. So incorrect is 3 only. So here you can see that in March 2026, bank credit grew by 16.08% in comparison to the last year. So this is the credit growth. The deposit growth was 13.47% in comparison to 10.28%. So credit growth is higher than the deposit growth. Credit growth is higher than the deposit growth. But in comparison to the last year, the deposit growth is higher than the previous year. So credit growth is higher than the deposit growth for the same period, but the deposit growth has improved compared to the previous year. That is also correct. The deposit growth has improved in comparison to the previous year. Okay. Now, during the pandemic years, credit growth slowed sharply to around 5 to 6%, while deposit grew faster due to precautionary savings behavior. So during the pandemic year, credit growth remained higher. No, it decreased. The growth was happening in the credit, but at a lesser rate. Deposit growth was stronger at that time period. Now coming to the next question, with reference to the new Form 121 introduced by EPFO, consider the following statements. Okay, the Form 121 replaces both Form 15G and 15H used for claiming TDS exemption on EPF withdrawals. The form is applicable only to senior citizens above the age of 60. It allows eligible individuals to avoid TDS on EPF withdrawals exceeding 50,000 subject to conditions. So see, the Form 121 has replaced the Form 15G and 15H. That is correct. And this form is for claiming the TDS exemption on the EPF withdrawal. So if the premature withdrawal is happening of the EPF, so this form can be used to claim TDS exemption. it basically allows the eligible individuals to avoid TDS on EPF withdrawals that is exceeding 50,000 subject to some conditions. So first and third is correct, second is wrong because the form is not applicable only for the senior citizen, it is for all the individuals. So 1 and 3 is the right answer, correct statement you have to find. So C is the answer here. Yes. So Employees Provident Fund Organization has replaced the form 15GE and the 15H. There were two different forms on the basis of the age. Now a single form has replaced the two forms because it was leading to some confusion. Now EPF withdrawals exceeding 50,000 are subject to tax deducted at source, but you can use the form 121. This allows the eligible individuals, those with income below the taxable limit, to claim the EPF withdrawals without tax deductible at source. So form 121 allow the eligible individual, those with income below the taxable limit, to claim exemption from TDS. But the form must be filled every financial year and the exemption is not automatic. Okay. Next is under the NPCI guidelines, biometric authenticated UPI transactions introduced by Paytm are subject to a maximum per transaction limit of how much? So basically, instead of putting the PIN, now you can do the biometric authentication for the UPI payment. So you will not be required to put the PIN. The biometric will be your yes for the payment. Okay. So, but there is the transaction limit of 5,000. Very good. Transaction limit of 5,000. So this is the idea that the 197 Communications Paytm has introduced the biometric authentication for UPI payments, and there is also the cardless ATM withdrawal facility. So the Paytm users can now authenticate UPI transactions without using the UPI PIN, just through the biometric method, putting your face scan or putting your thumbprint on the mobile phone. Biometric based UPI transactions are capped at 5,000 per transaction, as well as there is also the cardless ATM withdrawals that you can do at the supported ATMs. Users can scan the QR code displayed on the screen using the Paytm app and verify instantly with their biometric or UPI PIN to complete the withdrawal. So basically, in the UPI transactions using the Paytm, if you are doing the transaction up to 5,000 rupees, then you will not be required to put the UPI PIN. If you want, you can just do the biometric and the payment will be done. Okay. Now coming to the last question that you have to answer, which insurance scheme has recently been onboarded by NPCI Bharat Bill Pay Limited as a biller under the insurance category on the Bharat Connect platform? So Bharat Connect platform is basically the platform which allows you to pay different bills, insurance premiums, if you want to pay electricity bill, water bill, any kind of bill. Okay. Now, and the insurance premiums you can pay. Now, which of these have been recently onboarded by the NPCI Bharat Bill Pay Limited as a biller under the insurance category? Postal life insurance. So basically, the NPCI Bharat Bill Pay Limited has onboarded postal life insurance as a biller under the insurance category. So if you want to pay the insurance premiums for your postal life insurance, you can pay the insurance premium through the Bharat Connect platform that is supported through 700 Bharat Connect enabled apps. Now, who can tell me that which is the entity, which is the bank, which is the technical partner which is joining this postal life insurance with the Bharat Connect platform? Which is that entity? Which is that bank that is the technical partner for onboarding the PLI on the Bharat Connect? It is State Bank of India. Very good. So State Bank of India served as the biller operating unit, managing the technical integration between the insurer and the platform. This is it. So this is it for today. Now do tell me in the comment section below that how many answers you have given correct out of 21 of the finance current affairs. So there were 35 questions in the RBI notifications, RBI press releases, and 21 questions for your finance current affairs. So do tell me how much marks you have got. Okay. Chalo, any confusion, anyone? So I tried to bring some new questions also for the course students as well as for the students that are doing the self-study. This is a kind of revision and you can use this PDF for your fast revision. Okay. And before ending the session, let me also show you that if you go to edutap.in, you can go to courses section, and in the courses section you can see the RBI Grade B courses. Here these are the courses that we have launched. There is also the launch of Ramban Current Affairs for the phase 1, where you are getting the GA questions, 3,500 questions. 3,500 questions have been provided for the general awareness. Like, these are the final 100 questions that we are providing for the schemes, reports, GA, finance current affairs, RBI notifications. Final 100 questions for the GA. There are 5 units of the final 100 questions. So 500 questions you are getting for the GA section. So here you can see that so many of the questions you will be able to solve. 3,500 questions you will be able to solve for the general awareness, and through these questions you can revise. If you already have a crash course, you can revise through these questions. If you do not have the crash course, if you are doing the self study, then you can use this Ramban Current Affairs MCQ for your revision also. Through these MCQs, the coverage has been done in a comprehensive manner. Okay, and the price is only 1,500. So this has been brought for the students that wanted a course for the general awareness, or that wanted to cover the general awareness through the MCQs format. They wanted to practice also, revise also, and learn also. So this is a solution for all of those. Okay, as well as if you want to solve a lot of the questions, these are the new 3,500 questions that have been prepared by the team. But in the course, if you already have the crash course, then you can solve the questions in the crash course. In the crash course itself, a lot of MCQs have been provided. But if you you do not have the crash course, you are doing the self study, you can buy the Ramban. Or if you want to solve even more questions, then also you can have the Ramban Current Affairs. Okay, chalo, this is it then. Kashish, in the course we have the reports session where we will be revising the reports. Otherwise, I will, in the marathon session now, I will be able to take the important reports. Okay, chalo, thank you everyone, thank you for joining.